we have to cover our safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, and Jeff Notice. Do your own research. We're doing our best, coming up with our own stuff, but certainly encourage you to also do your own research to kind of complement what we're working on here. Before I hop into the macro side of things, I will give a slight warning. There are some charts in here that are a little scary, a little Dr. Doomish, but I do want to highlight one key overarching idea, which is within the global economy, it still remains the case, in my opinion, that the United States remains kind of the diamond in the rough. So on a relative basis, whatever's happening in other parts of the world, it looks like it's going to be less bad here. And then even more specifically, whatever's happening within the United States, I would argue that on a relative basis, the manufacturing sector actually looks like it should hold up better. So what am I talking about here? I really enjoy this chart, and I apologize if you're getting blocked a little bit by our screens, but we've looked at this in the past. But what this is purchasing managers index data. So this is, again, a survey that goes out to thousands upon thousands of purchasing managers, asking them whether or not they're seeing conditions getting better, worse, prices going up, they going down, how are backlogs, and then they compile these surveys, and they do it on a global basis. So what we're looking at here is the last 12 months of PMI data. So going left to right, September 2021 through August of 2022. And as you can see pretty clearly, as you go from left to right, we're moving out of a lot of green territory into a lot more yellow and even a bit more red as we work our way to the right-hand side. And a couple things I really want to highlight, first of which is going to be China. Just in the last 24 hours, China, unfortunately, has announced another round of lockdowns, this time about 21 million people. So not as big as what it has been in the past. It's one of their smaller cities, which is kind of crazy to say considering it's 21 million people. But as you can see here in the manufacturing data, their PMIs have softened back below 50, having been above 50 for the last number of months, or last couple of months. Moving down the list a little bit, we're going to spend a little bit of time here in a few slides talking about Europe, but there's no doubt about it. Europe is having a tough go of it right now. You've probably seen some of the headlines with regards to their lack of energy security, power prices going to the moon. We've got some charts here in this presentation that are going to run through some of that in more detail and talk about some of the knock-on implications that may have to metals. Now, I don't know what the heck is going on in India, but they are really the key one that's sort of bucking the trend to the upside. You can see them midway down, 56 PMI. That's a pretty darn strong PMI data point in the face of the rest of the world really kind of hitting a little bit of a slow patch. And then lastly, working our way down to the United States, 3 from the bottom. Yes, we're softening. Growth rates are softening here within the United States, but it's still growth on a year-over-year basis. So that is worth highlighting. I want to make sure that that's digested in the face of some of these maybe ugly charts that I show here in a few.
Hey Nick, question. India growing strong, like you said. What are some key maybe exports or commodities that are made out of that region?
Yeah, I mean they're big exporters of steel. They're big exporters of iron ore. They certainly have their own domestic coal market where they export some of that, but yeah, they're big net importers of a lot of things as well. And I hate to be too cynical here, but there is a chance that some of what Europe's issues are becoming beneficiaries for India. And what I mean by that is there's a chance that India is actually consuming more Russian natural gas, more Russian crude oil in the face of Europe putting up its own sanctions. So that could be one of the things that's been going on over the last couple of months, is they're actually getting cheaper energy.
And I don't know if you're going to get to it in a few slides, but parking in on China there for a little bit, beyond that PMI data that came out, I don't know if you're going to mention it, but steel production down month over month there, right? Is that?
Yeah. And actually, yeah. So Mike just about a week ago sent me an article highlighting the fact that, and some of these things are no real secret. We've talked about them in months past, but the property sector within China is quite weak. That obviously has knock-on implications to demand for commodities, and one of those being steel. We'll talk about it here in a few slides, but steel prices within China are several $100s lower than where they are in Europe and the United States. and that can be constraining to profitability. And the article that he had sent me was suggesting that estimates are around 30% of their steel industry is at risk of going bankrupt. Why does that matter? Well, on one hand, that's bad news because companies are going bankrupt. On the other hand, the potential knock-on implications that 30% of China's steel companies going bankrupt would have almost instantaneously, if that happened, that would better balance global supply-demand conditions for steel. So in a weird way, you could actually see that propping up other markets outside of China with the steel pricing.
Yeah, really
appreciate bringing that up.
Yeah.
So we talked a little bit about kind of the Fed's goals over the coming months in prior podcasts, and I promised myself I wasn't going to say the R word, but in my opinion, the Fed's kind of trapped, and they're trapped between two bumpers really, and the first of which is going to be inflation. That's the obvious one. Inflation rates are running around 40-year highs, basically the highest since the 1970s. And the Fed is doing its best to try and bring that back down to more reasonable levels. No matter where you look, whether it's food prices, energy prices, airline tickets, things are more expensive now than where they were a year ago, 2 years ago, at a pretty rapid pace as well. So that's the first task that the Fed's really trying to take on full force. Unfortunately, they can't just do that magically. They can't just wave a wand and bring inflation back down. One way that they can do that is to kind of damage the economy, either on a domestic basis or on a global basis. So towing that middle ground is looking to me to be incredibly difficult, where, yeah, we might be able to bring the prices of energy down. We might be able to bring the prices of food down and get people to stop spending more. But will that send us into a recession? And God forbid, maybe that sends us into a deep recession and we actually see, negative several percent GDP growth. In some scenarios, I think that may actually be required because, unfortunately, things like energy aren't really fixed by bringing up interest rates. And Jay Powell has kind of acknowledged that in prior months, where he's basically said, I can bring up interest rates as far as I want. It doesn't create more natural gas, doesn't create more electricity. So other things perhaps need to take place to bring those things down. But what the Fed has also acknowledged is, so I guess as we take a step back and we say, all right, what is the Fed watching, or what can we as purveyors of the Fed's dialogue, what can we be watching to kind of understand their perspective? Well, the first of which is going to be obviously the inflationary data, and more specifically, the Fed indicates that they look primarily at core inflation. So core inflation being any inflationary data excluding food and energy prices. That's going to be shown here on this chart in the white line, and you can see for the last couple months, core inflation has actually started to creep down a little bit. Admittedly, even in the last month, headline inflation has even come off from its 40-year high, albeit still very, very elevated levels. 4.5% on core inflation. Yeah, it's good that it's ticked down over the last couple of months. It's nowhere near where they want it to be. I don't want to put words in their mouth, but I would say, they're not really going to, they being the Federal Reserve bank presidents, they aren't really going to get comfortable until they start seeing rates somewhere south of probably 3%, maybe closer to 2%, because we've seen prices rise very rapidly for the last many months. So that's the first thing we're going to keep an eye on, is core inflation. The second is jobs data. So ultimately, as the Fed is hiking interest rates, and that has some sort of a headwind effect to the housing market, the auto market, construction markets. One of the big things they're going to be watching is that causing layoffs? Is that causing people to lose their jobs? So we're going to be watching jobs data very closely in the coming weeks and months ahead as well. One of the data points that I think we touched on last month is this chart here, which is the JOLTS job openings here in the United States. And within the United States, we've currently got 11.2 million job openings still out there. And I know I mentioned last month that I thought we were in a recession already because of the 2 quarters of negative GDP. I will readily admit that if there's a contradiction to that idea of us being in a recession, it's jobs data. If we look at jobs alone, this data is extremely strong. You can see it in the job openings here on this chart. If you look at the unemployment rate right now, it's about 3.5%, which is extremely low. So if we are in fact in a recession, it's the weirdest recession we've ever had because jobs are very plentiful and for anybody who gets laid off, there are jobs that are out there to be had. They may not be your dream job, but they do exist. So until or unless we see a lot of layoffs and the unemployment rate move up or job openings move down, the Fed kind of feels a little emboldened to continue hiking rates, continue chopping away at the economy a little bit until or unless things really calm down. Their ultimate goal is that people stop spending money at quite the rate that they have been over the last several months and quarters.